Good evening, everyone. Welcome all my students to my macroeconomics lecture. And it's a very short-term lecture, but anyway. So, welcome everyone again. I hope that you're doing well, even under this hard circumstances associated with developing this so strong and hard virus. But anyway, the history of economic development keeps a lot of evidences supporting that time to time the hard economic and political and social events time to time happened. But what to do? Life is life. So we have to recognize the economic procedure as the unavoidable process that we don't need to change immediately. We need just to recognize, to understand, really evaluate, and then think about how to change this situation, what to do. Okay, so after this very short introduction, I would like to start the new topic for today. So what we want to discuss this lesson, we plan to discuss the monetary policy of the government. Well, if you remember, when we studied the macroeconomics, we discussed the different economic systems and explained how the national economies may develop under the specific economic systems. And every time when we discuss the market economy, we especially emphasized that the market economy implies the independent entrepreneurship and absolutely free market processes with very low government. But it doesn't mean that the government doesn't need to do anything. Well, if you remember the classic economic school, I mean, probably you remember the major representative of the school, like Adam Smith, and his invisible hand approach to the role of government in the economy. Because by Adam Smith, the government doesn't need to intervene because the internal market forces direct the economy in the right way. But after the Great Depression and after the Second World War, some economic theories significantly changed, perhaps because of the efforts made by great American economists like John Maynard Keynes. And even though he was the main proponent among the main proponents of market economy, he also supported the significant economic regulatory role of government in national economy. And among those regulatory roles, firstly, we have to talk about the two major policies of the government. One of them is monetary policy, and the other one is fiscal policy of the government. So perhaps the title of this slide, I mean monetary policy, can explain a lot of things to the students who can interpret the dictionary meaning of this word. So monetary, the root of this word is money. So even if we don't know what is monetary policy, even if we don't have any ideas how to interpret this word, we can think about, we can predict that perhaps it's something concerned the policy of the government directed on the supply of money in the market, or maybe how to regulate the monetary inflows and monetary outflows. Okay, so let's go further. Okay, so what is monetary policy? Basically, when we talk about the monetary policy, we have to understand that that's a very complicated process. And within the frames of developing of this process, the monetary authorities of a national economy of any country have to think about the ways how to control the total supply of the money in financial markets. So simply saying, if you want to answer the question, what is the monetary policy? You have to say, yeah, that's a process by which the different monetary authorities, financial authorities of a country controls the total supply of money. Sorry. Okay, that's a very interesting picture from the famous movie. Okay, how can the government realize the monetary policy? There are two different approaches. First one, the monetary policy could be expansionary and contractionary. When the monetary policy is expansionary, it means that the government needs to increase total supply of money because the economic target is to develop economy further, to help economy to move rapidly than the normal, usual velocity of developing of economic activity. So what can the government do to expand total supply of money? Well, think about this. Probably we'll talk about this later. Well, in contrast with expansionary, we have contractionary monetary policy. Well, under the just circumstances typical for the different national economies, contractionary monetary policy implies the situation when the government tries to expand money supply a little more slowly. So the government tries to take the finger on the pulse of the monetary supply. And in terms of profitability and in terms of supporting the total national economic interests of the country, the contractionary monetary policy tries to lower the turnover of total money supply. Okay. Well, frequently, the monetary policy is designed in terms of different, more complicated economic events, more complicated than total supply of money. Unfortunately, the hard economic situation very frequently goes together with unemployment and deflation, or vice versa, unemployment and inflation. Now, I would like you to have a look on this slide. I want to offer you this specific problem, macroeconomic problem, like existent unemployment and deflation processes occurred at the same time. Then I offer the remedy how to leave this hard situation. And on the next column, you see what does it mean? How can we use this? And what are the major ways to realize this? So we have unemployment and deflation. So you know what is inflation? Inflation implies the total price increase concerned with different bundle of goods, at the same time lowering the purchasing power of money. Deflation is strictly opposite situation, when the prices go down and formally the purchasing power of money goes up. But it doesn't mean that this situation is so desirable for economy, because we have to think about the interest of producers. If you want to stand on the just on the place of the producers, so probably you'll think about the interests. How can the producers increase the profits if the prices time to time go down? So deflation also is not so desirable for the successful national economy. Well, how can we leave this situation in terms of the tools of monetary policy? So the first step that the government has to do under these circumstances is to induce the expanding supply, just expand supply of money. Because when the government tries to expand supply of money, this situation will immediately encourage the consumption and in turn spending. Well, because when you expand the money supply, you have immediately reduce interest rates. Lower interest rates in the bank encourages customers and the other even investors to spend more. So expanding supply of money immediately lead to increasing in spending. Well, how can the government realize this expansionary policy in terms of expanding supply of money? The government may buy different bonds in open market. So by doing so, the government will support the open market operations. Because when the government buy the bonds, it means that the customers who want to sell their bonds, they change their money into the bonds and vice versa. So by buying bonds in open market operation, in open market situation, the government may slightly expand supply of money. Okay. The next problem, the second situation, that's opposite. Now we don't have inflation, we have opposite situation, inflation. So inflation, I want to remind again, is total increased price level and lowering purchasing power of money. So one of the major remedy or major economic policy under these circumstances, just contractionary policy. So the government has to realize monetary policy by lowering the supply on money and lowering spending, and at the same time can do this by increasing interest rates. Okay, imagine the simple situation that the banks offer a little higher interest rates. As a customer, as a regular citizen who has some money, for example, some savings, what we can do about? Well, higher interest rate makes banks more attractive for customers. So probably we'll think about keeping our savings in the banks. If we do like that, it means that we lower spending, because if we have money, we have to save them, we can save them or spend. The higher interest rates in the banks attracts away the majority of savers from buying additional goods, products. So they try to lower consumption, to lower spending and increase saving. Well, one of the major means, actually, how can the government do that? The government may decide to sell bonds again in open market. So by means of open market operations, the government sells bonds, and by doing them, the people who rely on the government securities prefer to relocate the part of their savings in form of bonds. By doing so, the government lowers the total supply of money, like paper money, in the market. If you have other questions, please, I'll be happy to answer. You can send your questions in my email address or just immediately write me in the chat. Okay. So the open market operations, formally, open market operations imply buying, selling of different government securities. Well, what are the securities? Normally, they are issued by reserve banks on secondary markets. The other way, okay, so how can we do that? You can see 3 different ways. Yeah, first one, the more reliable, it's manipulate short-term interest rates in the banks. The second one is manipulate supply of base money, the cash in form of cash, paper money, and the third is control the total money supply. Well, the manipulating the short-term interest rate normally is realized by the central bank of the country or Federal Reserve banks of the country. Okay, this scheme explains how this process, buying of securities from commercial banks usually are realized. So the banks, we'll start with bank, may give up securities and pays the bank. Then by doing so, the bank tries to increase reserves. So that's the relations between the different commercial banks if they want to buy securities. But this is not the only way. The securities you can buy from public as well. So imagine that the public, the community of customers, they give up securities and they pays for them, goes to deposit, like in form of deposits in the bank, and again goes to the bank. By doing so, the bank will increase internal own reserves. Okay, if we discuss with you the buying procedure, now you see how the selling process is realized. That's the process that describes the selling securities to commercial banks. Then the central bank or the federal central bank gives up securities to the bank. Bank pays for them and then may sell to the next bank by decreasing the reserves. The same situation we can observe when the public banks and Federal Reserve, the central bank, interact with each other. So central bank may give up the securities and the public pays check from the bank. Then from the public, the money again flows to the next commercial bank. This operation helps to decrease reserves of the bank. Okay. Now we have to understand what we mean when we say reserve requirements imposed on commercial banks. So I mentioned before that the central bank carries out an important role in realizing the direct monetary policy. And the central bank may use different tools, financial tools, monetary tools, to control the situation. And among this is the imposing reserve requirements. What do we have to understand when we say required reserve? That's a specific certain fraction of deposits kept by a bank that a depository institution, for example, bank, is required to reserve. Why do we need this requirement? Because the banks may be encouraged to offer a lot of credits, a lot of loans. But if the own reserves of the bank don't allow the bank to cover the loans, it will be very hard to pay back the loans if one of the clients of the bank, imagine in case, may apply and require all his or her savings. If the money are not in the hands of the bank, the significant portion is not kept by bank like reserve, it will be very hard to realize and to pay back the savers his own or her own money. Okay, so this reserve requirement, or simply saying required reserve, is imposed or normally set by central bank. So central bank is the major bank of all banks in the country. And this requirement also helps to affect the size of loan that the bank can offer. That's actually what I was talking about before. Now, because it's very important to commercial bank to keep under control the size of possible loans. Otherwise, it will be very frequently lead to the bankruptcy, or that's more worse, to lowering the prestige and of the bank and reliability of the bank. Okay, so required reserve and monetary policy are closely related because required reserve imposed by central bank of the country helps to control the size of all loans offered by commercial banks. Now, the other very popular tool, that is discount rate identified by the central bank. So what a discount rate, how we have to understand this? Look, in the majority of the countries, the banking system consists of the two different stages. The first one is Federal Reserve or central bank. And the second one, that's a stage where the majority of commercial banks and different credit organizations are standing in the country. So the commercial banks need support from the central bank. At the same time, the central bank needs to control the activity, business activity of commercial banks. So central bank identifies the discount rate, that is the interest rate charged by Federal Reserve banks, that's in the United States, or any other central bank. For example, in Azerbaijan, we have the central bank, that's the first stage of banking system. And the second stage, we have commercial banks and the different credit organizations that normally are not classified like banks, but at the same time, they may offer different loans. So this discount rate is interest rate that the central bank charges or Federal Reserve banks charge to depository institutions, for example, commercial banks, on short-term loans. So that's the definition of discount rate. Why this is important for commercial banks? Why this tool is so sensible and important? Because discount rate, simply saying, is the rate that the commercial banks have to pay if they ask loans from the central bank. Okay, before discussing the general goals of monetary policy, I would like to add something to discount rate. If by lowering the discount rate and increasing discount rate respectively, the central bank may affect the total supply of paper money in turnover inside the internal financial market of the country. Because when the central bank increases discount rate, it means that the loans, the credits for commercial banks become very expensive. That's why they don't want to offer more credits, more loans to entrepreneurs for different firms, enterprises, because it's very expensive to get them back. And if the central bank lowers the discount rate, the situation sharply changes situation, because now the commercial banks think that it's good time to get the credits, the loans from central bank, and offer different opportunities for businessmen, for the entrepreneurs to get relatively cheaper loans. So by lowering discount rates, monetary policy helps to increase money supply, and vice versa. By increasing discount rate, lower the supply of money in turnover. Okay, now you see the goals of monetary policy. So the major goals of monetary policy, firstly, of course, is economic growth. Then, price stability. Well, how can we reach the price stability and economic growth? Of course, by combining two major tools, providing stability of interest rates offered by banks and the total financial market stability. Then, if we discuss the stability in financial markets, if we talk about the interest rate stability, so perhaps final target will be the higher employment, because we have very deep relationship between the inflation rate, it means the price level stability, and unemployment, and of course the employment also in turn. And at the end, we have to talk about the stability in foreign exchange market, because the interest rate stability, price stability, financial markets stability, at the end provides the extremely stable and strong national currency. The strong national currency means stability in foreign exchange markets. Okay. Well, and that's the information concerning the inflation rate. Well, I said earlier that we have very deep relationship between the inflation rate and unemployment. And of course, you may put my question, good, if we cannot avoid inflation, what level of inflation we have to support in order to reach a relatively stable price level, or simply saying price stability goal? So the example, like an example, you may use maintaining the inflation rate in the country between 2-4%. So that would be some kind of nominal anchor in price stability. Okay. The major problem associated with introducing right monetary policy is the time inconsistency problem. The time inconsistency problem happens because, or arises because major policymakers in the country are always just trying to pursue monetary policy and to make them more expansionary, because they believe that expansionary monetary policy, which raise the economic output, will help to increase economic output. But sometimes the expectations, unfortunately, are not in accordance with our hopes. As minimum, even when we say that we have full employment or higher employment, it doesn't mean that unemployment is also at zero level, because as minimum we know that we have frictional and structural unemployment. Okay, so simply, yeah, I just would like you to have a look on the major goals of monetary policy in terms of the everyday life. So the higher employment, it doesn't mean that we have to make exactly unemployment zero level, because it's really impossible. And economic growth implies that we have to ensure that resources are not idle, stability of financial markets. Well, it means that the financial crises and as a result, the deep economic crisis can interfere with the main function and doesn't cover any other specific types of this. Interest rate stability definitely means uncertainty, instability in the economy. And finally, stability in foreign exchange market. Now, that implies that probably it's easy to businessmen or the entrepreneurs to plan what they want to do in the future, in near future. Okay, that's it for today. Actually, that's everything that I would like to deliver today for you and to discuss with you, just to share. Well, as you can see, these slides are not so hard to understand, and I tried to include many pictures and less ones in order you can have a look on the textbooks, on the books, and find the support in terms of the evidences of my words. And so just a short review of all the questions that we discussed with you. So I would like to remind that the topic was monetary policy. So that is process which monetary authority of the country controls the supply of money. So the major target is to keep under the control the supply of money in the country. Then we have different types, so expansionary and contractionary, and the specific examples, problems, two types major of problems, and specific remedies and means, how to solve them, and perhaps the goals of the monetary policy. By the way, among the important tools of monetary policy as reserve requirements, and of course the discount rate. So now I'll wait for your questions. Please put the questions. If not, I'll be happy to share with you my questions. So I would like you to write